everyone, the topic of our presentation is the impact of Big Bots in corporate accounting, examining real-world examples and implications for major acquisitions.
My name's Isabella, and today I'll be discussing Big Bot's presence in the streaming industry. In accounting, a Big Bot refers to an action taken by a company's management team to intentionally undermine current year earnings to present better quality results in a future period. Big Bots can be seen through a variety of accounting processes, including writing off assets, recording large restructuring costs, or goodwill impairment. Considering the change in customer viewing preferences highlighted by Dan Barrett, an example seen of this recently is that of the AT&T Group following the merger of Warner Media and Discovery Inc., creating the now consolidated Warner Bros. Discovery. Following the merger, Warner Bros. Discovery significantly increased both its content and development write-off costs as well as restructuring and impairment charges, surpassing its projected figures by approximately $1 billion, with total costs now amounting to $5.3 billion, as outlined by the Hollywood Reporter's article on the increased cost. The corporation utilized content write-offs from canceling shows while consolidating the two companies' respective streaming sites, HBO Max and Discovery Plus, to scrutinize viable shows for future financial growth, or to decide if cancellation was a more financially sound decision as they could write these off, further fortifying the Big Bot maneuver. Benefits to Warner Brothers included investment control. Increased costs in the year can be framed by management as merger transition costs, which prevents panic and can be seen as responsible financial management. It also protected public shareholder view, as a corporation taking significant hits in one year looks better as continuous losses every year. Future financial statements also look stronger by virtue of this. It also created opportunities for streamlining processes to improve efficiency and allowed these corporations to reduce underperforming divisions. Other general benefits included cleaning up a balance sheet, as well as creating avenues for tax benefits, especially during initially high profit years, as these companies can reduce their tax burden.
Hi everyone, I'm Katie, and I will be discussing the advantages of granting managers the flexibility to charge impairments on our sites. So let's begin with the first key benefit. It's timely reflection of economic changes. In fast-moving industries like streaming, conditions can shift quickly. If viewers are switching to TikTok or YouTube, platforms like Apple TV Plus need to respond. Discretion allows managers to recognize impairment as soon as future cash flows are expected to decline. According to AASB 136, this adjustment is of particular relevance when there is evidence that a site may not recover its value. Next, this flexibility improves the relevance of financial reports. Rather than waiting for poor results to show up in earnings, managers can send early warning signals through impairments. Investors get insight into what's happening now and what might happen next. For example, if Apple knows that a particular show won't drive future subscriptions, impairment it earlier shows transparency and foresight. Finally, internal strategy is supported by deficiencies. Business can improve their balance sheet and concentrate cash where it's most needed by writing down underperforming assets. For instance, blocking old HBO programming enables Apple to redirect resources to newer, more promising shows in the event that they purchase Warner Bros. In summary, discretionary impairments help managers respond quickly and allocate reports meaningfully and allocate resources more effectively.
For Apple to improve their Apple TV platform, they could acquire Warner Brothers Discovery. First, before we analyze the accounting implications of this acquisition, we need to understand how much the acquisition will cost and how Apple will be paying for it. WBD has a market cap of 32 billion, total debt of 37 billion, and we can apply a 25% buyout premium, the average for an acquisition as per the AFR, of 8 billion. The total cost of the acquisition for Apple should be around $77 billion. Apple could pay for this acquisition using multiple sources of financing. I've provided an example on screen of a possible financing structure. However, Apple could adjust relevant weightings depending on market conditions. It is very likely that Apple would use more than 50% debt financing. As Apple has an AA plus credit rating, it can borrow very low interest rates, making this its best source of financing for large-scale transactions such as the acquisition of WBD. Upon acquisition, Apple must comply with generally accepted accounting principles and revalue all WBD's identifiable assets and liabilities to their fair value as of the date of acquisition. This process is known as the purchase price allocation. This is crucial as WBD has a net loss of 450 million in Q1 25. As this information comes from an unaudited report, WBD could have engaged in aggressive accounting practices such as extending asset lifespans to reduce depreciation or recognizing revenues prematurely to try and reduce their net losses. These practices could misrepresent WBD's true financial position, which could be problematic for Apple. After Apple conducts their PPA, they could calculate their goodwill gain from the acquisition. Using WBD's balance sheet as of Q1 25, a goodwill of approximately $41 billion will likely be created through this acquisition. However, this amount of $41 billion is premature, as the goodwill amount will be calculated by Apple after they revalue WBD's assets and liabilities to fair value, instead of relying on the carrying amounts. This final calculated goodwill will then appear on Apple's balance sheet as a non-current intangible asset.
Following the acquisition, Apple's consolidated financial statements will change significantly. Under GAAP, or also in the Australian context, Australian Accounting Standards Board, specifically Section 3, Apple must incorporate WBD's reevaluated assets and liabilities into its financial reports. This will affect balance sheet structure and overall key financial ratios. For example, Apple's liabilities will increase with the assumed debt, increasing its debt to equity ratio, while the fair value reevaluation of WD's content libraries and intangibles will expand Apple's asset range. Apple will also consolidate WD's revenue streams, including HBO Max and Warner Brothers Studios, introducing new revenue streams into the business, in the short-term expenses such as amortization of intangibles and restructuring costs may reduce reported profit for the short term. So this brings us to the next question: can Apple take on a big bath? Well, the answer is yes. A big bath allows companies to recognize large one-off impairments, like writing down underperforming assets within the acquisition year. This will ensure precise information is provided on assets and liabilities in the acquisition year and will reset expectations for shareholders. Strategically, this deal positions Apple to compete more aggressively in the streaming service space by leveraging WD's established streaming brands like HBO and CNN, and the potential to bundle it all into Apple's ecosystem, which incentivizes customer retention and also will invite new customers to come in and try out their new product line. Ethically, however, there are risks. Overstating goodwill and manipulation of impairments are one and can mislead investors. Under ASB 136, Apple must test their goodwill annually and disclose methods clearly, and if not followed, can risk audit qualifications, reputational damage, and regulatory scrutiny.
Hi, my name is Jitang Hu. Let's imagine a scenario. In 2025, Apple acquires Warner Brothers Discovery in a business combination. As part of the acquisition, Apple would recognize a significant amount of goodwill on its consolidated balance sheet, representing the premium paid for WBD's content, brand value, and customer base. But what happens if the streaming industry continues to decline over the next 5 years? WBD's expected future cash flows would fall short of initial projections, and Apple could be overstating the value of its assets. Under the AASB 136 impairment of assets, the impairment should be tested for at least once a year, and if the recoverable amount, that is the present value of future cash flows, falls below the carrying amount, then Apple will be required to record an impairment loss, which would directly reduce Apple's net profit and lower its total assets. And this is where it becomes critical. These impairment tests are based on subjective estimates, such as future cash flows and discount rate. And this can create a highly judgment-based accounting risk, as these assumptions are not audited in real time, which may create room for manipulation. For example, if Apple uses only optimistic assumptions, it may delay impairment recognition. But if the business is already underperforming, there might be a deliberate large impairment in a future period, which could be considered as big bath. Now I will hand over to Shengning Dai.
Hello, I'm Shengning Dai Danny. Let's talk about big bath accounting. It is a tactic where companies take a large loss in one bad year, especially when they are knowing they already have a tough time. They may write down goodwill all at once to make future profits look stronger. It's often used when performance keeps getting worse, but management delays the write-off to a more convenient moment. This is why investors start asking, why now? Why didn't they do this earlier? This kind of timing creates suspicion. It looks like earning management, even if it is technically allowed. So the issue isn't just about the loss, it's about how honest the timing feels. So, how can companies avoid that suspicion? It comes down to transparency. Investors want to know how the company made its decisions, what forecasts were used, what discount rates were applied, and which segments were struggling. This is where something like CEDS helps. In Australia, the Consolidated Entity Disclosure Statement forces companies to review all entities in the group and where they are based. It is a tool to help investors understand complex structures. Maybe in the future, we could have a version of CEDS that applies to impairment decisions too, so that the assumptions are more visible, not handled behind the vague numbers. In conclusion, what are the key takeaways? If goodwill is large and the streaming business keeps declining, impairment is always certain. Trying to use big box accounting may help in the short term, but it damages credibility. And once investors lose trust, it's very hard to get it back. That's why clear, timely disclosure, like through CEDS or other tools, can help Apple management expectations honest. At the end of the day, good accounting builds long-term trust. And in a tough industry, that kind of trust is worth more than any quick fix. Thank you, that's all. Bye-bye.